The game of tennis has captivated fans of all ages around the world. But what do match points and market trends have in common? Today's guest argues that there are a number of parallels between tennis and the investing tactics one must take to outperform the market. Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Polito. Joining me is Ronald Van Loon, portfolio manager in BlackRock's fundamental fixed income team. Ronald will help us explore the similarities and the differences that investors can take from this fast-paced game and how the mental game of tennis can also translate to investment strategies and beyond. Ronald, thank you so much for joining us on The Bid.
Thank you, Oscar. Thank you for having me.
So, Ronald, when people think of the sport of tennis, I don't think they're necessarily thinking about investing at the same time. And for those who are thinking about investing, I don't think they're thinking about the sport of tennis. But you would argue that there are similarities between these two things. And I know you wrote a paper on this topic. So I'm curious, what caused you to draw this comparison initially?
It all kicked off really by a speech that Roger Federer gave at Dartmouth College back in June.
Today, I want to share a few lessons I've relied on through this transition. Let's call them tennis lessons.
And the speech was around life lessons, really, that he can bring from his career in tennis to the new graduates. The speech itself is on YouTube. It's a great speech. And there was one particular bit that I thought really stood out.
Perfection is impossible. In the 1,526 singles matches I played in my career, I won almost 80% of those matches. Now, I have a question for you. What percentage of points do you think I won in those matches? Only 54%.
That means even Grand Slam players only make per point only about 54% of the points they played. I thought that's amazing statistics, right? Most people think about Roger Federer, surely one of the greats of the game of tennis, only makes per point about 54% of the points. And that brought me to a paper I wrote in the Journal of Portfolio Management, which is asking the same question, but now in investing. And the question really was, what percentage of the investment choices that you make need to be correct in order to make positive alpha or positive excess return? And also there, the percentage was remarkably low, much lower than people originally thought. So that's how I made the analogy between the two efforts.
And Ronald, when you refer to alpha, that's basically that ability to outperform the market. So you're saying there's a parallel between Federer's comment around the percentage of points that he won in his career and then how that applies to decision-making and that ability to outperform the market. So how do you square Federer's statistic? I mean, he is one of the greatest tennis players of all time. How is it that can be the case when he's only winning a little bit over half of his points?
It's really the nature in the game of tennis. Tennis is quite a unique sport in that it offers a lot of opportunities to score. And tennis is quite a unique sport. In a single match, you have multiple sets, multiple points. That's also the reason, for example, why the rankings, you have these periods when a certain small set of players tend to dominate the rankings, because there's so many ways of how to express that skill, per point skill, across multiple games, multiple sets, and so forth. And that's quite unique. The second bit is, of course, Federer, even though he only has 54% of the points that he wins, he applies it in a very consistent and persistent fashion. That's also a bit of an analogy really to investing.
Right. You're saying that the sport of tennis is just unique in terms of how many times during a match you can apply your skill. And so I think you started to talk a little bit about how this then applies to the world of investing. Why is this similar to an investor who's trying to outperform the market?
Yeah, so investing shares certain characteristics really with tennis, and that also is that you have a lot of opportunities to score, right? In the investment markets themselves, they're volatile, there are enormous breadth of opportunities. There's a lot of choices to be made across asset classes, across securities, and also through time. So then if you look at the investment horizon that people care about, which is usually multiple years, and break that up into all the investment decisions that make up that period, you get to the same really scenario. You get a lot of opportunities to score. That means also in investing, as in tennis, you need to be right a remarkably small percentage of the time in order to lead over the long term to consistent results. And that really is what the paper was about. What we did was we worked out what percentage of the investment decisions need to be correct over the long term to come to a successful investment track record. We had to work it out for across some of the public markets in equity and fixed income. You have to assume some transaction costs and so forth. But the number we came out could be as low as 53%. So it's really remarkably close to what Roger Federer mentions in tennis.
Right. So to clarify, you're saying that to generate alpha, to generate outperformance, you need to be right only, I think, a little more than 53% of the time in order to be successful. And again, that parallels with what Roger Federer talked about in that commencement speech. So help us understand, how did you get to those numbers? And what do you mean by an investment decision? What is an example of one of those decisions you have to try and get right?
It's fairly straightforward. So what we did is we started with some of the public markets and looked at the variability or the volatility of returns and started to measure them over different frequency over which people make decisions. So it can be monthly, quarterly, annually, or weekly, or whatever period. You then need to add two elements to the mix. One of them is transaction costs, right? Because they do eat into returns. You need to make some assumption about that. And then the second bit is skill. So how do you measure skill? And in this paper, we took to kind of two extremes. We started off with a no-skill case, where every decision is a 50-50 decision, whether or not it's successful. On the other end of the spectrum, you have the kind of the 100% skill case, where all investment decisions work out to be correct. And then you can start interpolating between these two extremes and run simulations and so forth, and then work out what is the percentage of skill where you flip to a positive excess return. And in some of the public markets, that can be as low as 53%.
So we've talked a lot about the similarities between tennis and investing, which is that you have a lot of opportunities in which you can show your skill or make a decision. And it turns out the percentage of time that you have to be right is maybe surprisingly low to be deemed successful. But maybe we could flip this a little bit and talk about the differences between tennis and investing, and how do these matter?
I can highlight two, really. One in favor of tennis, one in favor of investing. The one in favor of tennis really is transaction cost. In investing, we have to pay a transaction cost every time we execute on a decision. In tennis, Roger Federer does not have to pay the umpire every time he takes a shot. That's clearly in favor of tennis. And you would argue, well, perhaps that's a marginal effect. But if you look at it over many decisions, these transaction costs do add up. So it's an important thing to manage in your investment process. And it's clearly a benefit for tennis. So 15 love for tennis there.
15 love.
In investing, the second difference I would say is probably the fact that there's an asymmetry in return. Not every point is of equal importance in investing. You can make some simple analogy in tennis. Let's say if you lose the first point and then make the second point, you're back to deuce. In investing, let's say first decision not correct, you lose, let's say 10%. Second decision is correct and you make 10%. You're not back to where you started, which is the effect of compounding. And that's, of course, a unique thing. So in investing, really, you have that kind of asymmetry in returns, and that's probably more so than in tennis. So every point, upside versus downside, is important. So you can have an investment process, for example, where you have many decisions that turn out to be correct ones and work for you in your favor, but there can be perhaps a handful of decisions that have really large drawdowns that then negate that, or vice versa. So that upside versus downside is really very important in investing. And you have an element of that as well in tennis, right? So not every point is the same. You have these crucial points in the game that can really turn the game on its head or switch direction, right? Break points or points in tie breaks and things like that.
6 games all, final set tie break.
But it's probably more so in investing. And by the way, I have to say, Roger Federer, and I did have to look this up, is a master in converting these crucial points. He converts 71% of his match points, for example, much higher than 54%. But yeah, as I mentioned, in investing, that part of the equation is probably more so managing the upside to the downside. In tennis, that's called winning the big points. In investing, we call it convexity.
So Ronald, maybe continuing down this analogy between tennis and investing. I'm not a huge tennis fan, but I know enough that there are different types of shots that you can take in tennis. There's the forehand, there's the backhand, there's a volley, there's the overhead smash. How do these different types of shots apply to the different types of investments that an investor can deploy in different market environments.
Yes, that's right. I guess in tennis, if you look at the best players, really, they have a very wide arsenal of different shots that they can apply. And they can apply them the appropriate shot for the appropriate environment, right? Whether it's grass, hard court, or clay, also depending on the weather conditions, and of course, depending on whichever opponent they are facing. And the really top players really have an unusually wide array of shots that they can play. There are also some things that they need to do consistently at every game. Like think about, for example, the techniques around the serve. There's not much variation in it. That's really around the consistent application and training. And I think some of that translates over to investing quite well. I wouldn't necessarily make the direct analogy between this shot, overhead smash is perhaps equal to that type of strategy. That's maybe a bit too far. But I think where the analogy does translate over quite well is the necessity of having a wide array of investment techniques and investment approaches to your arsenal as an active portfolio manager. And particularly around a variety of different market environments, whether it's a bull market, a bear market, high interest rates, low interest rates. There's a variety of different environments. And as a good active manager, you need to have the different investment techniques and different investment approaches and apply those at the appropriate time in the appropriate scenario. And I think this is really where the analogy lies between the tennis and investing, about having the breadth of resources and knowing when to apply which technique to which investment environment.
Right. So different shots in tennis are appropriate at different times of the game, depending on where you are on the court and where your opponent hits it. In the same way that different investing tactics might be appropriate depending on the market environment and what's in front of you. And that helps you determine how to navigate your portfolio.
That's where you have a portfolio that can be positioned for a variety of different market environments, whatever may come.
Ronald, if you're an investor listening to this, and whether you're a tennis fan or not, what should you be taking away from this conversation or this rally, if you will, that you and I are having, that they could apply to their own investments?
Yes, I think Roger Federer in his speech, one of his kind of life lessons is called, "It's only a point."
It's only a point.
What he's trying to say is that in tennis, you shouldn't dwell on the kind of the past points that you might win or lose.
Okay, I came to the net, then I got passed again. It's only a point. Even a great shot, an overhead backhand smash that ends up on ESPN's top 10 playlist, that too is just a point.
Always look forward. Look on the consistent and persistent application of your edge on the point to be played. And I think some of that translates into investing quite well, actually. If you think about how to gain an edge in the markets from an active management point of view, it's trying to get the odds in your favor by getting slightly more investment decisions right than you get wrong, trying to skew those odds between the upside and the downside of the return, managing that convexity. And once you have that edge, it's really around the consistent and persistent application of that. And I think that's a strategy that Roger Federer highlights in tennis, and I think that translates over to investing quite well.
I think he also talked about in that speech the mental aspect of it, that ability to lose a point, but then have to think about the point ahead and put the loss behind.
When you're playing a point, it has to be the most important thing in the world, and it is. But when it's behind you, it's behind you. This mindset is really crucial because it frees you to fully commit to the next point and the next point after that.
Perhaps for an investor, a similar thing is being able to forget about that loss, think about the investment ahead, and that there's a mental aspect to being a successful tennis player and also being a successful investor. Would you agree with that?
Yes. I think what he mentions really is that the relative differences in skill between the top players in the Grand Slam tournaments is really quite marginal. And it's really around the application of that skill, the discipline around it, and the practice. He mentions a lot, right? The practice that goes into achieving that 54%. I think a lot of that translates over to investing quite well.
I think you also said he practiced a lot for the speech that he gave. You made a comment to me about the preparation that he put into, similar to the tennis matches that he would play over his career.
Yes, I think in an interview afterwards, a journalist asked him about how did you prepare for the speech? And he mentioned he prepared for it for 6 months. That's amazing. And I think it's the true show of character and how he approaches not only tennis, but also presentations.
Well, I'm curious if you read your paper that you published in the Journal of Portfolio Management, and to the extent that maybe that served as a little bit of inspiration. But Ronald, we've been talking a lot about tennis. I have to ask, are you a tennis player or do you enjoy watching tennis? Do you have a favorite player that you follow?
Yes, I don't play tennis much myself, I have to be honest. I do watch it. It's a fantastic sport. I do a lot of other sports, and I like to watch other sports as well. One particular element that I like is sports data analytics. Of course, it's a new field, so it's very exciting. What I particularly like is trying to tease out the human story behind the numbers. And I think with that 54% that Roger Federer mentioned, there's a big story there.
Well, I'm not much of a tennis player myself. I think I'm part of this growing legion of people playing pickleball, which is perhaps it's an application of tennis, but I know tennis requires a lot more running and is a bigger court. Ronald, we really appreciate this interesting take that you have on how to draw parallels between sport and investing, and we appreciate you sharing it with us here on The Bid.
Thank you. Thank you for having me.
Thanks for listening to this episode of The Bid. If you've enjoyed this conversation, check out the episode with Tom Becker and Kate Moore, A Cruel Inflation Summer, where we consider how consumer demands have shifted and how their desire for experiences, such as Taylor Swift's Eras Tour, have impacted inflation around the world.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.